What do cryptocurrencies have to do with the US's record debt? How can you have $34 trillion in debt and never go bankrupt? The United States has exceeded $34 trillion, an off-the-charts number. If you counted $1 per second, it would take you more than 1,000,000 years to get there. Yet the system does not collapse. Supermarkets are full, stock markets are at their highest, and the dollar remains the most traded currency in the world. If it were a family or a company, it would already be in court. But the US is not a family. It is the issuer of the global reserve currency. And while everyone is staring at the Treasury and the big foreign buyers pulling out, a quiet Plan B is emerging. In this video, I show you why crypto and stablecoins are not the enemy of the system. They could be the missing piece to unload the burden of debt without ever officially declaring default. To get to the Plan B I was talking about, we first need to clarify one thing: how to cancel debt without canceling it. There are 3 ways.
Global devaluation. Debt doesn't disappear, it's redistributed. To understand how cryptocurrencies fit into the debt game, we must first understand how debt can be reduced without actually repaying it. In practice, there are 3 ways. Growth. You generate so much value that the debt becomes less of a burden. This is the hardest option today. Default. You say, I won't pay. Political and economic suicide. Devaluation, the preferred route. Imagine the entire economy is a single 100-pound note. I borrow it from you. I owe you 100 pounds. But I have the printing press. I create another one and put it into the system. Now there is more money in circulation, but houses, petrol, and bread remain the same. Over time, prices rise. When I pay you back your 100 pounds, I have paid. But with that 100 pounds, you buy less than before. It is not a legal default, but a real one, an invisible tax that transfers value from the lender to the borrower. The United States has been doing this for decades. The point is that today, with record debt, a new way is needed to offload this devaluation on a global scale. The point is that this game is not new, only the tool has changed. To understand this, look at what I'm about to tell you. If so far the video has given you a different perspective from the usual, then leave a like and subscribe to the channel. It helps me bring content of this caliber more and more often. But now, let's get to the crucial point: understanding why the United States has already used this scheme in different forms at other times in history.
The historical playbook of the dollar. 1933, 1971, today. American history is punctuated by moments when the rules of the game were rewritten overnight. These were not secret conspiracies, but political decisions made in the open. 1933 and the seizure of gold. During the Great Depression, the government realized that it could not devalue the dollar as long as citizens could take refuge in gold. So, with Executive Order 6102, Roosevelt forced citizens to hand over their gold to the state at a fixed price. Once all the gold had been collected, the government raised its official price. In one fell swoop, the dollar was worth less and the state coffers were worth more. 1971, the end of an era. For years, the world accepted dollars because they were as good as gold. You could go to the Fed and exchange paper for metal. But when the US spent too much on the Vietnam War and social programs, gold reserves began to decline. Instead of cutting spending, Nixon simply closed the gold window. The dollar became a fiat currency based solely on trust and military power. Today, the era of atomized liquidity. From 2008 to the present, we have lived through a period of zero interest rates and massive liquidity injections. But this model has a limit. If you print too much and no one wants to buy your debt securities anymore, the house of cards collapses. China and Japan are reducing their treasury reserves. A new buyer is needed. Someone is needed to buy American debt without knowing they are doing so. And the disturbing thing is that someone already exists. It is not a central bank. It is millions of people.
and the channel is stablecoins. When the world buys Treasury without realizing it. This is where cryptocurrencies come into play. Forget Bitcoin and altcoins for a moment. Look at stablecoins, such as USDT, Tether, or USDC, Circle. What are they technically? Private digital dollars, one-to-one redemption promises. To maintain the peg, the issuer must hold liquid and safe reserves, and in practice, a large portion of those reserves ends up in short-term Treasury bonds, in addition to cash and Treasury-backed repos. Here's the twist. In recent years, stablecoin issuers have become structural buyers of T-bills at levels comparable to major global players. So when someone in Nigeria buys stablecoins to protect themselves from local inflation, or a trader in Europe uses them as cash in the crypto world, they are indirectly fueling demand for short-term US debt. And here's the move. Instead of depending on a few foreign central banks, demand can come from millions of users via apps. It's a democratization of funding. US debt is absorbed without those absorbing it perceiving it as a geopolitical choice. When demand shifts from central banks to apps, debt ceases to be just finance, it begins to become infrastructure. And in fact, debt becomes infrastructure, from large buyers to wallets. There is a huge difference between having debt held by a few large buyers and having it distributed among millions of small users. If a single sovereign actor dumps tens of billions of treasury bonds in a short period of time, it can create volatility, push up yields, and turn finance into geopolitics. The market is deep, but it is not immune to flow shocks. But if those same billions are encapsulated in millions of wallets in the form of stablecoins used for remittances, payments, and trading, it becomes much more difficult to turn them into a coordinated weapon. Demand is fragmented and integrated into everyday use. Debt becomes part of the infrastructure, no longer just a matter for auctions and central banks, but collateral that underpins digital dollars. And as long as the world needs fast digital dollars, there will be demand for short-term US assets that keep that peg in place, even if in times of stress, outflows can make more noise than inflows. Okay, we've seen what is happening. Debt is infiltrating the infrastructure. Now let's see how it happens step by step. Legal framework, mass adoption, macro effect. The reset is not a single day. It is a three-step process. Many expect a Hollywood-style great reset, a Monday morning with closed banks and money wiped out. But in reality, resets, when they happen, are processes, and they often follow three steps. Step 1. Legal framework. It is not about destroying cryptocurrencies, it is about standardizing them. Rules on issuers, reserves, audits, and redemption rights. And when you impose liquid and verifiable reserves for a dollar-pegged stablecoin, you almost always end up with instruments such as Treasury bonds or equivalents. Stage 2. Mass adoption. This is the stage we are at now. PayPal is pushing PUSD, Visa is bringing settlement in USDC, and stablecoins are becoming boring. When they are boring, they are infrastructure. Phase 3. Macro effect. If digital dollars become global, the global audience that absorbs dollars and dollar collateral also grows. It's a 21st century version of exorbitant privilege, not an instant reset, but a continuous rebalancing of costs on a broader basis. But every monetary architecture, however efficient and regulated, rests on one crucial condition: trust. The problem of trust and the role of gold. All this works as long as there is trust, but trust comes at a price. So why are central banks, whilst talking about digital innovation, buying gold at a rate not seen for decades? Over 1,000 tons a year for 3 years running. Because gold is the asset without a counterpart. It does not depend on an issuer's balance sheet nor on a political switch, especially if you hold it physically under your direct control. And here lies the paradox. Whilst the public is being encouraged towards a system of digital, collateralized dollars, those at the top are building insurance around a scarce, non-freezable asset. Conclusion: the future will not be crypto versus the system. It will be an integration. Crypto and stablecoins as the infrastructure for debt circulation, scarce assets as a defense of value. If this thesis is correct, then it must leave observable traces. And indeed, there are 3 simple metrics you can monitor over the coming months.
The 3 signs that the reset is already underway. Here's how you can track this shift over the coming months. Integration into messaging apps. When you can send stablecoins on WhatsApp or X as easily as sending an emoji, you'll know that Phase 2 is complete. US debt will have gone viral. The NSA narrative. Listen to the politicians. When they start saying that stablecoins are vital for the supremacy of the dollar, you will have confirmation that cryptos have been officially enlisted in Washington's army. The divergence between price and value. You will see scarce assets, Bitcoin, gold, luxury property, rise in price steadily. It will not necessarily be because they become more valuable, but because the currency in which they are measured is being diluted via the mechanism we have described. If you start to see these signs together, then the picture is clear, and at this point, we can draw our conclusions.
Conclusion: do stablecoins strengthen the dollar or buy time? So what do cryptocurrencies have to do with the US's record debt? They are relevant because in the form of stablecoins, they can become a new demand infrastructure for short-term US debt. The more stablecoins in circulation, the more reserves are needed, and those reserves often end up in instruments such as Treasuries. It is not a question of being for or against crypto. It is a question of understanding the rules of the new financial landscape. On a personal level, the point is not to beat the system. It is to avoid being exposed without realizing it to a currency that loses purchasing power over time. Think in terms of scenarios. If the trajectory is towards greater liquidity and gradual devaluation, the priority becomes building a more balanced exposure to scarce and diversified assets, those that cannot be created with a click, always in line with your risk profile. The system won't collapse with a bang, it will shed its skin. And now that you've seen the playbook, you can stop fixating on doomsday headlines and start looking at where demand is actually shifting. In your opinion, will stablecoins strengthen the dollar in the long term, or are they just a way to buy time? Write it in the comments. I want to know what you think. If you found the video useful, subscribe to the channel and give it a like. See you soon.